We are just days away from entering the so-called Santa Claus rally period, which spans the last 5 trading days of December and the first 2 of January. That's the technical definition. The importance for market psychology cannot be understated here. According to Ryan Dietrich over at LPL Financial, that 7-session stretch is one of the strongest of the year. The market spoke a gain about 79% of the time, with an average return of around 1.3%. But if the markets post a loss during that period, it's happened 5 times since the year 2000, then January has also ended in the red as well. Let's bring in our old friend, Jeff Kilburg, the Chief Investment Officer of Sanctuary Wealth. He's also a CNBC contributor. You know, the amount of times over my media career in business television that I've been talked about with regard to correcting the Santa Claus rally has been innumerable. Market technicians, maybe rightfully so, are very protective of it. It is 5 trading days at the end of December, 2 trading days at the beginning of January. How important is this, Jeff, for you as a trader and investor? Do you watch it, or is it just noise?
No, Dom, we actually do watch it. And happy holidays, pal. And we talk about this Santa Claus rally. And certainly there's been a lot of fog for Santa to get up and out on his sleigh. But sure enough, we're finding a way, looking for 3 trading sessions in a row to see this positivity. What's really interesting, if you look at the chart of the S&P 500, Dom, $4,700 has been really thin air. And the Santa Claus rally, which I do see testing new all-time highs and making new all-time highs before the end of the year, has really been driven by the overcoming of fears. Obviously, we're dealing with the 3rd bout of COVID, this variant right now, Omicron. Certainly the knee-jerk reaction was concern about additional lockdowns. We seemingly are overcoming that, and we're focusing back on the consumer. Look at the consumer confidence yesterday. As you know, Dom, the consumer drives 70% of our U.S. economic growth. That's up about 10% in the last 30, 40 years. So I really focus on these last 5 days and the first 2 days of this Santa Claus rally to set sentiment to a tremendous year, but also to set the tone for 2022.
What exactly is the tone, do you think, Jeff, for 2022, given what you've seen, not just this year in its entirety, but specifically in the last, say, 1 to 3 months?
Well, Dom, I would say my daughter's long list for Santa. I have a long list of why I'm constructive and why I'm optimistic moving forward. I'm actually going to be putting out my Outlook 2022 to my Sanctuary advisors next week. But let me give you a little preview here, Dom. And the real main reason, the undercurrent, we talk about tapering, we talk about interest rates, which I'm in the camp we're only going to see 1 rate hike next year. But the real undercurrent is the fact that the Fed's balance sheet is $9 trillion. That's with a capital T, Dom. And that type of safety net really provides the opportunity for the market to move higher. But we also look at things that we just don't talk enough about. Look at Q3. We had epic, historic buybacks. We saw 16% year-over-year growth in the buybacks. That was $258 billion just in Q3. Of course, Apple took about $20 billion of that $260 billion. But I look at all the different moving parts. We look at $4.5 trillion still in cash. So I think the biggest risk to the market in 2022, once again, Dom, will be not invested. I think you have to be invested, but you have to be considerate of what type of sectors you want access to and exposure to. And I think this grappling, this wrestling match between growth and value, that persists in 2022.
So, you know, it's interesting right now. There are a number of geopolitical risks that we haven't talked really at all about over the course of the last several months here. But maybe there's a reason, because geopolitical risks are transitory in nature and we haven't cared about them for years at this point. Is it fair to say in your mind that it's all about the Fed and all about COVID in 2022 as well?
I think it's more about the Fed potentially making a mistake. And it's interesting, Don. We've seen so many people talk about how the hawkish turn of the Fed. I don't think Fed Chairman Powell has been hawkish by any means. I think you have to separate tapering, separate that from interest rates, and really separate that from unwinding their balance sheet. He's been dovish from day one. He talked about on March 23rd, when we were at the market low in 2020, he talked about being there in unlimited capacity and in perpetuity. And that's exactly what they've done. So when you see this commitment, this dovish commitment, I think that really puts them in a position to have some optionality. There will be an additional variant in 2022. And Fed Chairman Powell is poised and positioned well to really have the ability not to raise rates, but to sit and react and let that balance sheet push the market softly higher.
You know, the word I haven't heard from you in the last few minutes that I thought I would have by now is inflation. because that's been a key point for many investors over the course of the last several months, and for good reason, because we are running at some of the hottest paces on record right now. Is inflation still going to be an issue for not just the U.S. consumer, which, as you point out, runs more than 2/3 of the U.S. economy, but for investors as well?
I think it is an issue, Dom, but I think it really dies down in Q2. We talk about inflation all the time. And what are two of the main drivers in these red hot inflationary numbers? It's used cars and it's new cars. And I think here sitting in Chicago, I was just on a car lot, a Chevrolet dealership yesterday, and they have a lot of used cars for sale. So I think this shortage of semiconductors, all these new cars sitting there with wrappers still on, I think we go from a shortage to potentially a glut. And that's going to bring inflation back down. And that plays into the hand of the Federal Reserve not needing to raise rates. So yes, we're seeing inflation very tangible, specifically here in the heartland of America. But nonetheless, I don't think that's shying consumers away. We are seeing consumers spend about $1,000 this holiday season on gifts and supplies. So nonetheless, that inflation is a concern, but I think we overcome it because it is going to pull back. I'm not going to use the word transitory, Dom, but I do see inflation cooling in Q2.
Now, Jay Powell is trying to take that word out of the lexicon right now. All right, before we let you go, Jeff. The dips have been bought. They continue to be bought. I don't know when it ends, but if they do hypothetically continue, investors buying dips, what exactly should they be buying if things pull back in price?
Well, I think you have to talk about this wrestling match between growth and value. So we talk about tangible blue chip names. We call them essential names. And look at some of these laggards. If you look at a Verizon, if you look at a Boeing, even if you look at a Visa, these are names that have not performed well. They've all been in the red in 2021. So I think you have to really consider, it's kind of a 2.0 of Peter Lynch. Buy what you know, buy what you use, Dom. I think you talk about those big names. Of course, Apple, of course, Amazon, of course, Facebook, all these names are in there. But I think the way you have exposure to these blue chip names, more of an equal weighted capacity versus the market weight cap,
sure,
that's going to bode well in 2022.